Hello and welcome back to Principles of Accounting 1. I'm still your host, Dr. B. We are halfway through the semester. Yay! That's a good thing, I think, right? We're halfway through the semester already, if you can believe it or not. We're in week 8, so that's halfway. For those of you who are keeping score, I want to show you a couple of things. So today we're going to talk about cash fraud and internal controls. But before we jump into that conversation, I want to take you to the classroom because I put a little gift in there for you. Okay, like I said, I got good news to share, and some of you may have noticed it already. I just put it in about an hour ago. So here we are in the classroom, and as you know, we're in week 8. So when you come down to week 8, sorry, okay, when we come down to week 8 and you open it up, you're going to notice a new item in here. And it says, oh, midterm exam review. Because the midterm exam is due this Sunday, right? And so I wanted to make sure that you all had an ample opportunity to be able to study for the exam. Okay? So what's going to happen today is we're going to cover chapter 8. We're going to talk about cash, fraud, and internal controls. And for this week, you have a couple of things you need to do, right? So if we look at this week, we have, oh my goodness, another LinkedIn Learning Certificate. So this LinkedIn Learning Certificate is on Excel. Okay, some of you have already done this, and thank you for that. Thanks for working ahead. I always encourage you to work ahead whenever you can, because as you know, this course does tend to get a little busy, and I also know that you have other courses going on at the same time. So for this week, we have a LinkedIn Learning Certificate on Excel. It's more specifically Excel for accountants. So throughout the course, you've already had one LinkedIn Learning Certificate on Excel, and I think that was all the way back in week 1, if I'm not mistaken. We had a LinkedIn Learning Certificate on Excel. So if you haven't completed that first LinkedIn Learning Certificate back in week 1, this is going to put you at a disadvantage. Okay, you really need to complete that week 1 first before you complete the one for week 8, because it builds on what you learned back in week 1. Okay, so again, these LinkedIn Learning Certificates, they're worth a ton of points. So if you don't do them, there's no way you're going to be able to pass this course. I'm just putting that out there, okay? So I'm looking at a couple names on this list, and I'm just saying, if you haven't done them, you're really far behind. Okay, I don't know why you haven't done them. I've provided you the clear explanation of how to do it. You know that I'm always available to you. If you're needing help, you can contact me. You have my phone number, you have my email address. Oh, and you can set up office hours. So there's no reason why you shouldn't have done them by now. Okay, so again, I'm stressing this very highly because it's worth a ton of points. If you have not yet completed the LinkedIn Learning Certificates, you are in trouble. All right, you have fallen so far behind, you're failing the course. Again, you cannot pass this course without completing those LinkedIn Learning Certificates. You cannot. All right, if you're struggling with them, you need to contact me right away. Because back in week 1, we had a LinkedIn Learning Certificate for Excel, and most of you completed it. There's a few who didn't for whatever reason, and I'm not sure why. And if you're really having trouble with it, you should have been contacting me for a while to get this situated. Yep. So LinkedIn Learning Certificate back in week 1 was on Excel, right? Now here we are in week 8, and guess what? There's another LinkedIn Learning Certificate for this week, and it's on Excel. Except it's Excel for accountants, which means it's going to be a lot more advanced than it was in week 1. So you need to go back and complete that one from week 1 if you haven't done that already. So that's the last time I'm going to say it. You cannot pass this course without completing the LinkedIn Learning certificates. It's going to be impossible because of the weight, right? So just as you did before with the previous LinkedIn Learning certificates, or should have done, you'll open it up, it'll launch. You need to make sure that you complete watching every single video in this list, starting from the introduction all the way down to the conclusion. And as you complete them, a green check mark will appear right next to the video, indicating that you've completed it. So as long as that green check mark is next to all of those videos, at the very end, after the conclusion part ends, you'll have a pop-up screen, and it'll look something like this, or something along those lines, right? And you'll select that top one, and you'll download the. I'm sorry. You'll select that top one, and you'll download the certificate and upload the PDF, just like you've done with the previous LinkedIn Learning certificates. Again, if you're having trouble with this for whatever reason, you need to contact me right away. Okay, please. You cannot pass a course without completing the LinkedIn Learning certificates, especially since they're worth several points each. Yeah. So hopefully you will understand that point. Sorry, Tim. Since you're all at the point, I just needed to reiterate that process. Okay, so that's the LinkedIn Learning certificate. Again, if you're having trouble with any of those, you need to get those. First of all, they're very well past due. But second of all, if you're having trouble, you need to contact me. I mean, I'm here to help you. I'm not here to penalize you for whatever reason. Okay, I want to help you. So if you're having trouble, reach out to me. Okay, so again, that's my soapbox for the LinkedIn Learning certificates. You have one to complete for this week on Excel for accountants. You also have the Chapter 8 quiz, which is about what we're about to cover, which is cash, fraud, and internal controls. And then the midterm exam is also due on Sunday night. So that's 3 action items for this week. This week's very busy, so I strongly encourage you to get started today, okay, and work ahead as much as you can. Right? Don't wait till Sunday to do all 3 of these things, because I promise you, you'll feel overwhelmed. And you really shouldn't be feeling overwhelmed right before you go into spring break next week. Yeah? So, just putting it out there. The midterm exam has to be done on time. Period. Has to be done on time. Period. I have to report your midterm grades to the university next week, so the midterm exam needs to be done on time. All right? I've given you a gift. That gift is this midterm exam review video. When you open this up, it'll take you to our YouTube channel for the class. Okay? You'll see the videos playing, and I'm going to explain very carefully how for you to be extremely successful on this midterm exam. I walk you through the process. So please watch that video. I promise you it's there for your benefit, okay? I would never steer you wrong. You know that. So please watch that video because I show you exactly what you need to review for the exam, how to do it, and how to be successful. I would encourage you to start the midterm exam early, like today. You can open and close it and save it and come back to it. It's not timed, okay? But it needs to be completed by Sunday night, right? You only have one attempt, and it's worth 200 points, which is equivalent to 20% of your total grade. So please, take your time with it. Open and close as much as you need to. Save it, come back to it, right? But watch that video because I promise you, I explain everything very clearly, and it's a complete walkthrough, so you'll be all right, I promise. So, okay, let's talk about cash, fraud, and internal controls. I apologize for jumping on the soapbox. I had to do it. I couldn't not do it. But I only do these things to help y'all. You know that. So, okay, why is it doing this? Uh, this darn thing is gonna. Okay, hold on just 1 second. I need to switch screens for just a second here. Okay, just to confirm, you can see the PowerPoint in a full window. Is that correct? You can see the
Yeah,
PowerPoint.
yes, yes.
Okay, and it's just the PowerPoint, right? You don't see like any notes or anything like that.
That's correct.
All right, cool. Thanks, Tim. Appreciate it. Okay, let's jump into it. Cash fraud and internal controls. Very important concept to understand because cash, as you know, is a huge part of business, right? It's a huge part of our business, especially. So it's really important to understand how cash works within the business. So we're going to focus a lot of our attention today on talking about cash. But before we jump into the bulk of the conversation on cash, I'm going to briefly talk about things like internal control systems. I'm also going to talk about fraud, how fraud happens, why fraud happens, that kind of thing, and how to prevent it. And then we're going to focus a lot of our time today on cash. So, as I mentioned first, I'm going to talk about this concept called internal controls. Internal controls act as a system when you combine all the controls together. The idea here is that we as managers or business owners or whatever your role is, supervisor or whatever, it's our responsibility as employees of the company to control our assets. We need to monitor them. We need to protect them. So in business, it's really important that we follow what we call a system of internal controls. It's designed, it's a set of policies and procedures really designed to help us to protect our assets. We need to make sure that our inventory is secure. We need to make sure that our process for tracking inventory is accurate. We need to make sure that our cash is properly secured, accounted for, and our balance in our bank account is accurate. Okay? We protect our assets. Remember, assets are things that the company owns, like cash, accounts receivable, inventory, property, plant, and equipment. We need to protect those assets. And we do that using a system of internal controls. This system of internal controls helps us to make sure that our accounting is reliable and accurate. It helps us to make sure that our policies for the company are upheld, and the internal controls also help us to promote efficient operations. Not every business has these written down somewhere, believe it or not. Especially a small local business. They might not have a documented process for their internal controls. But they should. They really should. I think every business should have this. So if you work for a small business and you don't have this, I encourage you to establish one. Back in 2002, there was an act passed by Congress called the Sarbanes-Oxley Act. The idea behind this is that for publicly traded companies, the companies need to have their system of internal controls documented and certified. The reason why this came about is because before 2002, there were times of fraud occurring in publicly traded companies. There's a couple of cases that I'm sure you've probably heard about at some point in your studies, or some of you have been around long enough to know about these. One of the biggest cases in American history was the case of Enron. Enron was a energy company in Texas that sold shares of their company stock, uh, and a lot of it was based off of things like the price of energy. And the company committed a fraud where they stated that their sales were were higher than they actually were. Now, why would somebody do that? You might ask. Well, it's to attract new investors. If you say that your sales are higher than they actually are, investors like hearing that. It's like, oh, the sales are real high. Well, that's good. So that would encourage new investment, right? Although the sales really weren't there. And so obviously that's fraud. It's illegal to lie about your sales in business. And so the Sarbanes-Oxley Act of 2002 was designed to protect investors like you and I who purchase stock in publicly traded companies against fraud, right? That was the whole idea behind it. So the act said that the companies have to have effective internal controls established, documented, and verified. Auditors must be able to evaluate this set of internal controls to ensure that the company is adhering to generally accepted accounting principles and are accurate in their reporting. You'll notice that for individuals who violate the Sarbanes-Oxley Act, they can receive up to 25 years in prison and a whole bunch of fines. In the Enron case that I had referred to earlier, there were a couple of high officials in the company that did go to prison. A few of them had passed away in prison, and then others got out and still owed millions and millions of dollars back to the shareholders. So, yeah, I mean, accounting is a very serious thing. That's why we take our work very, very seriously, especially when it comes to numbers and dealing with other people's money. Yeah. So yeah, that's what the Sarbanes-Oxley Act did, and that's why it exists today. Also, around that same time, there was another organization that was like, you know what, we got to figure out ways to help companies establish sets of internal controls, and it is called the Committee of Sponsoring Organizations, also known as COSO. And COSO formed this framework in order to help companies to establish their system of internal controls. And they said, you really should have these 5 components for your internal control system. So the first is controlling the environment. The environment is the company structure. It's ethics and integrity for the internal control system. The second is risk assessment. It's so important in business to be able to identify, analyze, and manage risk factors. Risk can come from outside the company. An example would be economic risk, where there's a downturn in the economy, and that downturn then, of course, translates into lost sales. We call that external risk, and that's more specifically economic risk. We also have internal risk. Internal risk could be things like employee theft, misappropriated funds, inventory shrinkage. I think we talked about that one a few weeks ago. Those are all risk factors internal to the company, right? So it's important to identify, analyze, and manage risk factors. The third criterion for COSO is for companies to have control activities. This is where the policies and procedures are created in an effort to reduce the risk of loss. Okay. The idea here is that policies and procedures govern the business in a way where we're mitigating risk. Fourth, of course, is information and communication. This includes reporting to internal and external stakeholders. Okay. Internal stakeholders are employees of the business. External stakeholders are the public, the government, right? Having clear, honest, transparent, and informative information and communication, very important. And then, of course, the last component here is monitoring. Regularly reviewing the adequacy of the internal control processes and procedures and the operation of internal controls is very, very important. So these 5 components by COSO really help to help companies to establish internal controls and also provides additional quality to those internal control systems. In accounting, we've identified 7 principles of internal controls. The idea here is that these principles are foundations for internal control principles for the company. First, of course, is to establish responsibilities of individuals, who's responsible for what. For example, I always separate roles and responsibilities in my company. The people receiving sales from customers, that's not the same people bringing the cash to the bank. Okay? Those are separated roles and responsibilities. Number 2 is maintaining adequate records. This kind of goes without saying, but making sure that you have your paper trail is really important. For example, for every sale I make to a customer, I have a couple of things. I have the purchase order from the customer. I have an invoice that I sent out to the customer, a copy of the packing slip that I sent out for the goods I sent to the customer, confirmation of the delivery of goods, and then of course when I receive a check from the customer, copy of the check, and I attach it all together. What that does is it establishes what we call a paper trail. Maintaining adequate records is critical, not just for businesses, but also for individuals. Think about this thing that we all do on April 14th called taxes. You're supposed to keep your taxes for 7 years into the past at a minimum. Okay? That's because if the IRS ever decides to audit you for whatever reason, you have documentation. Yeah, so maintain adequate records, number 2. Number 3, ensure asset and bond key employees. Okay, this is 2 parts. Insuring assets means having insurance on your assets. You purchased liability insurance for your assets to protect your assets, right? This is usually done through what we call an umbrella policy. An umbrella policy is an insurance policy that's purchased by the company to insure things like property, plant, and equipment, and then of course things like cash, accounts receivable, etc. Right? Insuring the assets. And bond key employees. Bonding key employees. What this means is you have a written contract that's legally binding between an employee and the company. And that legally binding contract that's insured by a bond helps us to transfer liability. What it means here is that if the person who has the key to the store, okay, they have access to our assets, that person needs to be insured with a company through a legally binding agreement. Okay, we call that bonding. Call that bonding. That's number 3. Number 4, separate record keeping from the custody of assets. Here's what we mean by this. Most businesses have an accounting department or a separate office. Okay. I keep my accounting records on QuickBooks, and I keep my records separate from the cash. Okay. Someone else counts the cash, someone else counts the inventory, someone else counts collects the cash from the customers. That should never be the same person entering the transactions into the accounting book. You see, you want to keep those two responsibilities separated because there's an opportunity for fraud otherwise. Number 5, divide responsibility for related transactions. Yes, the person collecting the cash from the customer should not be the same person reducing the account receivable in the accounting book. Divide responsibility. It's another example would be if you've ever worked in retail and had to go to the bank for the company, you know that those bank deposit box, the packs, right, with the cash. There should always be 2 individuals. The person who counted the bank should not be the same person bringing the bank to the bank. You see, person who counted the drawer should not be the same person making the deposit. Is what I'm saying. Number 6, apply technology. No kidding. This would be things like time clocks for punching in and out, security cameras, logging, biometrics for logging into the computer, etc. Technology, yeah. And number 7, perform regular independent reviews. Audit your stuff. Yeah. So those are the 7 principles of internal controls. We'll just breeze through because we just talked about all those things. Establishing the responsibilities, clear individual people should be assigned. Tasks should be assigned to individual people, right? This helps us to determine who's at fault when something goes wrong. Maintaining the adequate records, as I had mentioned, things like keeping detailed records, using the chart of accounts, pre-printed forms, pre-numbered sales slips, using a POS, also known as a point of sale system. I don't even know why they say computerized anymore. Everything is. Oh, yeah. So this goes back to the insurance and the bonded employees. Assets should be bonded, insured against loss. And then, of course, the bonding of the employee means the company purchases insurance for that employer. Yeah? That's where that legally binding contract I mentioned earlier is. Separate record keeping from the custody of assets. Whoever's taking the cash to the bank should not be the same person entering the transaction. Reduces the potential for theft and waste. Dividing the responsibility for related transactions. This helps to reduce the potential for error and fraud. Separation of duties. Internal controls, time clocks, ID scanners, security cameras, etc. And always audit, whether it be internal and external. An internal audit is when an individual working for the company does a physical audit of the inventory, cash, and other assets. An external audit is when a third-party company comes in and audits the company. And the third party audit is done for every publicly traded company. Some private companies elect to do this as well. And I always encourage all companies to have both internal and external audits every year. So yeah, all of these things together helps to reduce processing errors, creates separation of duty, leads to increased e-commerce, and of course is very it just allows for more opportunity for the company to grow and focus on what's important. Okay, blockchain. You may have heard this term before, blockchain. It's relatively new. It's been around for maybe I don't know, maybe about 5 years or so, but maybe 7 years now. The idea of blockchain is that it's a more secure type of accounting. It uses what we call a blockchain ledger, and it's continuously updating based off of real time information, and it's also verified in real time. The technology, of course, makes it more difficult for someone else to modify or change any type of records without some type of an alarm going off. The records also cannot be destroyed, hidden, or otherwise manipulated because it's shared and stored by multiple users. That's the idea behind blockchain, right? You may have heard blockchain from a financial perspective, or blockchain mining, data mining. I'm sure you may have heard this term before as well. The idea here is that the transactions are being encrypted and nothing can be modified, right? It's probably the most secure way of accounting. And of course, accounting and consulting firms are really investing in this new technology, and it's seems to be going pretty well so far. What are some limitations to internal controls? No one's perfect. Yeah, human error, definitely. People could be careless. They can misjudge things. They could be confused. Yeah, I mean, like I said, no one's perfect. We all make mistakes. So human error, definitely. Another limitation of internal controls, fraud. There's that. There's always somebody who's looking to game the system somewhere, and so they want to they purposely do something for internal for personal gain, right? Uh, Overriding one of my favorite ones. I mean, it just bothers me a lot. But so those of you who know, in a former life of mine, I was a financial controller for a hotel company, and one of my responsibilities was to audit our assets. And so one time I was auditing the restaurant at the hotel. And I was down there and I was counting the liquor bottles and measuring them to figure out how much inventory we had left for each one, right? To place a value on it. And I noticed some irregularities. A couple of the bottles were a little lighter than they should have been based off of the number of sales. And I was like, something's not right here. And so I was like, I wonder what's going on because, the sales kind of said that what they were, but the amount of liquor said something else. And so I was like, okay, so, clearly some type of fraud must have happened. So I started watching the tapes. I started watching the tapes of the camera, and I noticed uh, that the bartender was pouring the drinks, but ringing them up as something else, right? So it's like, okay, well, obviously that's fraud. So, just things to be aware of. That's just something from my personal story. Uh, why do people commit fraud? There's really three reasons. We call this the fraud triangle. There's opportunity for it, the internal controls have weakness somewhere. So there's an opportunity for the fraud to occur. There's pressure on the individual committing the fraud, financial, family, social stress. And there's rationalization for committing the fraud. The employee rationalizes what they're doing as being just behavior, right? They're saying, "Oh, everyone does it." That's rationalizing. So that we call it the fraud triangle. So it's important to be aware of these things. When you implement your internal controls, there's a cost benefit analysis at play here. So the idea is that the cost of implementing the internal controls should not outweigh their benefits. Okay. So that's the conversation on internal controls. I'd like to start to switch gears now and talk about something a little bit more important, well, equally as important, and that's cash. Cash is king, as they say, right? Cash is king. I'm sure you've heard this term before. Uh, Reporting cash in accounting is very, very important because cash is a very liquid uh, investment vehicle. Okay, cash is handled differently, and so because of that, it's really important that we have an effective internal control system on that cash, but also we record that cash appropriately. A couple of basic guidelines for handling cash. One is that the cash should be separate from the record keeping of the cash. In other words, the person making the journal entries for the cash should not be the same person actually handling it. Number two, the cash receipts are promptly deposited into the bank. Don't wait a week to go down to the bank and make the deposit. Okay, do it within a day or less, or two at most. Cash payments should be made by check or EFT, electronic funds transfer. You've all probably handled an EFT before. EFT is very simply virtual deposit into an account. Cash is extremely liquid. It is the most liquid, in fact, of all assets. In business, in accounting, on the balance sheet starts with cash under assets. And the reason why that is because on the balance sheet, you'll notice that the assets are organized by their liquidity. Right? I think we talked about this before a few weeks ago. They're organized by their liquidity. Cash is the most liquid. Accounts receivable, it eventually becomes cash, right? When the customer pays us. Short-term investments, definitely convert that to cash. Inventory, eventually turns into cash. Then property, plant, and equipment. I mean, you can convert it to cash, but it takes a long time. Cash is extremely liquid. Liquidity refers to the company's ability to pay its current liabilities. If you remember, we have something called the current ratio. Yep. Cash and similar assets are called liquid assets. And this is because they can be readily used to pay for liabilities. Cash includes things like currency, that's the paper money, coins, deposits into bank accounts, checks. Checks are the same as cash. Whether it's a personal check, money order, certified check, cashier check, it's all cash. That's all it gets treated the same way that cash does. That's all cash. Your debit card, that's cash. Yeah. That's all cash. Then we also have what's called cash equivalents. Cash equivalents are what we call short-term, highly liquid investments. They have to meet two specific criteria. One is that they can be readily converted into cash. And number two, that it's close enough to their due date that the market value will not greatly change. Here's what a couple of examples of this would be a U.S. Treasury bill, okay, or a short-term bond or a short-term note. Okay, they can readily be converted into cash or they're close to the maturity date. If you have like a 90-day loan that's owed to you, the closer you are to that 90 days, it would meet the cash equivalence criteria. Managing cash is super, super important. Okay, have a plan for cash receipts to meet the cash payments when they're due. You got to make sure you have enough cash on hand for your business to operate. Hopefully that's common sense. But if you ain't got cash to pay your bills, you're going to be out of business. Very straightforward. Okay, so make sure you have enough cash on hand to pay your bills. All right. And to pay your employees. Oh, for those of you who are in business and you're making a decision to hire people, when you hire someone and you're going to pay them, make sure you have a separate bank account for payroll only. And you have to meet a minimum required balance for that account. Just so you know. Number 2 is keep a minimum level of cash necessary to operate. Treasurer is responsible for this typically in a business. If your company doesn't have a treasurer, your financial controller, your accountant, someone in that area is responsible for it. How to effectively manage the cash. Encourage your customers to pay you and to pay you early. Okay. Remember we talked about, I think it was last week or the week before, we talked about discounts, right? Give the customer a discount. Why you do that? To encourage them to pay their bill early. Yeah. Encourage the collection of receivables. Delay the payment of liabilities. Sometimes you can stretch it a little bit, you know what I mean? You got that 14-day, what do they call that? That window, a 14-day window. After that, they consider it late. You know what I mean? Sometimes you can be a little slow to pay. It's all right. Except for your employees. Don't slow pay them because that'll be bad. Keep only necessary assets. Don't purchase too much inventory. Please don't do that. I've seen so many businesses do that and they get themselves in trouble, okay? Purchase only the assets that you need. Plan expenditures ahead of time. You know when the rent is due. Make sure you have enough on hand to pay the rent. And the last one here is invest excess cash. If you have extra cash on hand, it's okay to make short-term investments with it. Just make sure they're not risky. Maybe get a little interest even. Okay. Let's talk about the handling of the cash, receiving it. Customers can pay you typically in one of two ways. Either in cash at the time of the purchase, or they'll pay you later through what we call accounts receivable. Now, when they pay at the sales point, at the point of purchase, typically we're taking their cash and putting it into a cash register. Okay? I've been there. I've done that. Okay? The register. Let me tell you a story about the register. So now, I'm sure you've all seen a cash register, and maybe some of you even know how it works. But they scan the item, They hit total, comes up with the total for the item, usually includes tax. Let's say the total is $15.50. I hand them a $20 bill. They should be giving me $4.50 change. Should be giving me $4.50 change. Now, sometimes it doesn't always happen the way that it's supposed to, right? Sometimes they're not the greatest at math. It's okay, you know. Instead of the $4.50 change, they give me $5. Okay, see you later. I just got myself 50 cents over, right? It's not so good for the person running the register, though. That person probably going to get in trouble. Or instead of the $4.50, they give me $4 back. Okay, well, I guess they're going to just keep that at 15 cents for themselves. Now their drawer's over 50 cents. You see? So it's important that if you're collecting cash from your customer, you want to make sure you give them the right change, number one. But you're also documenting that, right? So you're collecting the cash from the customer, you're giving them the product. That's a transaction, right? Your inventory went out, cash came in. A sale came in, cost of goods sold went out, right? So that cash at the end of the night, after all the sales are totaled up, they print what's called a Z tape from the register. The Z tape is a running total. There's a real long slip comes out, and it should tell you exactly how much cash should be in the register. And then, so you count all the cash, make sure it's properly there. And then if it's over or under, you note it, yeah? And then you leave whatever is supposed to remain in the register, and then whatever's left, you bring to the deposit box. With the deposit box, you're also submitting the cash sheet and the register receipt. In the morning, when the accounting office comes in, they take that information, they enter the register tape into the QuickBooks or the accounting information system, and the rest of it goes off to the bank. Yep. That's how we handle cash when it comes over the counter. Now, I'd mentioned, sometimes there's an error involved here. You gave too much change or you didn't give enough. Okay, we all make mistakes. I'll tell you though, you can get in trouble if you're a cashier and you're over or under, you get written up. Yeah, I had a couple of students tell me stories about when they were cashiering, and they would get written up because their manager or whatever didn't, the company didn't tolerate that kind of thing. So, just word of caution. So sometimes we make errors with making change, etc. If the cash register shows $550, but when you count the cash, it shows $555. Whoops. We still have to make an adjusting entry for that in the accounting office. So we debit cash $555 because that's what's there. We credit sales $550 because that's how many sales we actually made. And then we credit this account called cash over and short. We credit it to represent the amount that is over. Okay? It happens, but you still have to adjust for it. Now, what about a shortage? Sometimes that happens too. You didn't give enough change back to the customer. Whoops. Or I'm sorry, you gave too much change to the customer. Whoops. Okay, that happens. So cash register showed $625 in sales. We counted the register. There's only $621 in there. What happened? Gave too much change. We debit cash 621 because that's what's actually in there. We debit cash over and short $4 because that's what's actually missing. And we credit sales 625. Notice that your total debits always equal your total credits. You all know that, but I'm just saying. Okay, this next part, hopefully I don't have to say this more than once. Never send physical cash in the mail. Don't do that. Even if it's a birthday card you're sending out, don't put cash in the mail. Don't do that. Please don't do that. Okay. Don't put cash in the mail. You know that, right? Just don't do that. It's dangerous. Why? Because the postman, well, sometimes that postman will be like, something in here. No. We hope not, but cash gets lost quick. So when you're paying something through the mail, write a check. Okay. Write a check. Okay. When we receive checks in the mail, typically a business will assign 2 people to open the mail. Why? Because one person's watching the other person. Accountability. The cashier deposits the cash in the bank. The checks. They're depositing checks. Okay? The record keeper records the amounts received in the accounting records. Remember, separation of duties. That's what happens when we receive customer payments through the mail. Control of cash payments. Yes, control the cash as much as possible. For the obvious reason, cash is very liquid. It's very important to limit theft. Keys to controlling the cash payment. Require that all cash payment be made by check, not by physical cash. Limit access to the accounting records except for those who have the authority to sign checks. Because the person signing the checks needs to know that there's enough in the account to sign checks. And with a cash budget, you should always have a cash budget for your business that includes cash projections into the future of when customers are expected to pay you, and also for what we call working capital. We'll talk about that here in a little while. So recently a student asked me, "Oh, Dr. B, what about Venmo? What about Venmo? Or what about whatever else you guys are using these days?" It works the same way as cash. Yeah, absolutely, because it's coming out of that person's account and going into your account. It's cash. Yeah, it works the same way as what we call EFT, electronic funds transfer. So, I got a lot of students that have small businesses. I got one student, she owns a food truck and accepts payments through Venmo and the other apps. Yeah, works the same way. It's treated the same way as cash. Now I need to talk to you about what we call a voucher system. A voucher system is a set of procedures and approvals designed to control cash payments, okay, and the acceptance of liabilities. It's basically a paper trail. That's what a voucher system is. It's a voucher system. A voucher system tracks the cash payments through a paper trail. All right? Verifying, approving, and recording liabilities for the eventual cash payments, issuing checks for cash payment of verified, approved, and recorded liabilities. That's a voucher system. I always use a voucher system for every bill that I pay for the business. Okay? For example, it's actually on the next slide. Here's my example. The hotel would purchase a lot of stuff from Cisco for the restaurant, or from Elsco for the linens, or from whoever else. Yeah, and so the vendor would, we would place the order using a purchase order, purchase requisition, whatever, purchase order. Uh, the vendor would send us what we ordered, along with a packing slip, also known as a receiving report. And so, what I would do is I would take the purchase order, the invoice, the packing slip, and I'd staple them all together, enter it into the accounting system, and then I would print out the payment, right, whenever it was due. And that payment, there would be a check along with the remittance for the check. I'd staple that to the other documents. Okay, and then I would take the check and bring it to the controller, or the general manager. They both would sign the check, and then I would take that check, put it in the mail, send it off to the vendor. Right? But that was the process. That's the voucher system process. Right? You see the paper trail involved here. Yeah. So that's the idea behind a voucher system. Now, also at the hotel, we had this thing called petty cash. At the front desk of the hotel, sometimes we would have customers that would come in, or guests that would come in from a cab, and we would pay the cab fare, right? Well, late at night, the accounting office isn't open, so they're not writing a check to the cab. So they would use the petty cash fund behind the desk. Or what if they had to run down to the post office to buy stamps? We're not going to write a check for that. That's silly. Just take cash from the petty cash fund, go down to the post office and buy the stamps. Or there was this lady that she would always come in like every Tuesday, and she would, with fresh flowers for the lobby. Okay, we're not going to give her a check. We'll just pay her in cash. It's a petty cash fund. Boom, right there. Instead of waiting for a check. Come on. For minor stuff like that, like those things I just described, we use what's called a petty cash fund. Not all businesses have this, but if your business has this, this is what it is. We use cash to pay for small things that are needed quickly, and avoids the time of writing a check for a small amount. Okay? So what it is, it's physical cash. Okay? To create a petty cash fund, we debit petty cash and credit cash. What that does is it creates what we call a petty cash account. Right? Here we have the example. Our corner market, remember? We establish a petty cash fund for $75. So we debit petty cash and credit cash. Now, throughout the month of November, we had a couple of small expenditures. All right. On November 5th, somebody had to drive and go pick up merchandise. Cost $15.05. We had to purchase office supplies for immediate use. $7.75. Another delivery expense, $5. Tile cleaning. Something happened. We had to get the tiles cleaned at the corner store. Okay. Throughout the month, we spent $71.30 of cash from the petty cash fund. Now, at the end of each month, we need to make an adjusting entry for our petty cash to show what we spent it on. Right? So here we have our 4 transactions. Transportation of merchandise. So merchandise, office supplies, delivery expense, cleaning expense. So we need to make an adjusting entry. So at the end of November, We debit merchandise inventory, $1,505. Debit office supplies, $475. Debit delivery expense, $5. Debit cleaning expense, $46.50. We credit cash, $71.30. Okay, we started the month with $75 in our petty cash fund. We spent $71.30 of it. I need to replenish that account, right? So how do I do that? I debit petty cash and credit cash to replenish it, right? And eventually get it back up. And then as it goes up, we debit petty cash and credit cash. As it goes down, we debit cash and credit petty cash. Yep. So that's how petty cash funds work. Again, not all businesses have them, but if yours does, that's how it works. Now, a couple of other things to note, and we talked briefly about this with my example from the cash register, the over-under. The same concept applies with petty cash, okay? Because we know that sometimes, gave a little too much to that vendor, it wasn't what I expected. I don't have a receipt for that. That happens. So we'd say it's over or under. If the petty cash fails to obtain a receipt, it'll cause petty cash balance to be over. Petty cash receipts plus anything left will not be in the total fund balance. Okay. Shortage, of course, is the difference. Overage is shortage is debited. Overage is credited. So since I'm short $7 because I didn't get a receipt for whatever, I debit the $7. So that's what happens if it's over or short. Works the same way as the cash register situation. Banks. A couple of things you need to know about banks. As you know, banks provide services. They provide checking accounts, savings accounts, deposit tickets. When you go to take cash down to the bank, you use a deposit ticket. And that deposit ticket also includes a list of checks that you're depositing. The bank might provide you with signature cards or a stamp. And of course, the bank also provides the bank statement at the end of each month and a list of electronic funds transfers. This is an example of a deposit ticket. We use it to deposit physical cash and checks. It's a list of the cash in terms of currency and coin. And on the other side, it's a list of all the checks, the check numbers, and the amounts. Of course, we total it all at the end. Serves as proof of deposit. Keep a copy of that, yeah? Of course, for checks, a check is a check. Hopefully you've seen checks. I know that they're becoming a little bit more rare these days because a lot of things are done electronically. But this is an example of a check. Hopefully you've seen this before. Who's making the check? Who's being paid to? The amount. The signature of who's paying it. At the bottom, we call this a remittance. A lot of checks have what we call carbon copies, right? It's the paper on the back. It shows an imprint of what you wrote down. That's a check. A bank statement. So at the end of each month, it's really important to what we call reconcile your bank account. What this does is we need to match whatever our bank account physically has to what's being shown in our QuickBooks, in our accounting system, right? So the way we do that is through a process called reconciliation. Gotcha. So for bank reconciliations, uh, oftentimes we need to make adjusting entries for bank reconciliations, and there's a couple reasons why we need to do this. Uh, on the bank side, we need to adjust for things like deposits in transit, meaning I went to the bank, I made the deposit, but it hasn't posted to the account yet. Okay. I also need to subtract out any outstanding checks. Outstanding checks are I wrote the check, but it hasn't been cashed yet, right? I paid my Pepco bill, but Pepco hasn't cashed it yet. Okay. That's called an outstanding check. Now we add or subtract any bank errors. Yes, the bank makes errors sometimes. On our accounting system, we also need to account for things like interest and unrecorded cash receipts, right? We have some deposits that haven't made it through yet. Interest earned on the bank account. My bank account has a balance that earns a percentage of interest. That interest shows up on the bank statement. So you got to add that into your accounting system. Subtract any bank fees or non-sufficient fund fees. Bank fees are fees that the bank charges just for having an account with them. Okay, unfortunately, some banks still do that. And non-sufficient funds fees. Hopefully, that never, ever, ever happens to you. But sometimes a customer might write you a check, and that check ain't no good because that customer didn't have the money in the bank. So, what happens is that your bank will charge you a fee, and the customer will also get charged the fee on their side. So, or if you don't have enough money in your account, you'll get charged a fee. And then, of course, we need to add or subtract any uh, book errors. So that's how we do bank reconciling. This shows us uh, how they balance, right? So on the bank side, cash balance for the bank plus deposits minus outstanding checks plus or minus any bank errors equals the adjusted cash balance. That adjusted cash balance will equal the adjusted cash balance on our accounting records. Cash balance per the book plus collections and interest minus any bank fees, non-sufficient funds, plus or minus any error equals the adjusted cash balance. This is a visual representation of these adjustments going through 4 steps. The first step, of course, is to enter the bank statement balance for the cash account based off the bank's balance. This example is $2,050. Second step is to add any checks in transit. This example 145, giving us an updated balance of $21.95. Minus outstanding checks. There are 2 of them, 150 and 200 for a total of 350, giving us an adjusted bank balance of $1,845. On the accounting record side, our QuickBooks, our balance shows $1,405 of cash. We're going to add any funds in transit that we haven't collected yet, which is $485 plus any interest of $8, giving us updated book balance of $1,898 minus fees from the bank, $23 check printing fee. That kills me. And taking out $30 for non-sufficient funds, giving us an updated adjusted book balance of $1,845. And lo and behold, they balance, right? They are equal. When they equal, we call that reconciling. So when they're reconciled, the idea here is that at the end of that month, when you start the new month, the cash balance in your accounting record in your QuickBooks should equal exactly what you have in your bank account at that time. Sometimes you might need to make an adjusting entry here and there. So those type of adjusting entries look like this for bank reconciliation: debit cash, credit note receivable, debit cash, credit interest revenue for interest earned, debit. I would actually call this bank fees and credit cash. Insufficient funds, I would debit the customer that the check bounced from, and credit cash. Because you better believe the customer paying for that. Okay, so that's cash. Now, it wouldn't be an accounting class without at least one or two ratios, you know that. So I want to talk to you about the days sales uncollected ratio. The idea behind this ratio and the reason why it's important is because it measures how quickly the company convert its accounts receivable into cash. How many days does it take? Okay, and we do that by taking account receivable divided by sales times 365 days. Yeah. Obviously, the shorter number of days, the better. Uh, and then this last part, last few slides here, has to do with the documentation and verification. Remember, having a paper trail, really important, especially when it comes to receiving or sending cash. For invoice approval, this is usually a printed out check that involves a signature and a remittance. And of course, we talked about the voucher system. So just things to remember. Okay, we've reached the end of our discussion on cash, internal controls, and fraud. Now I'd like to, let me just switch this screen back. Hold on just a second. This thing always gets to be a little much. Stand by, please. I apologize. Let me stop sharing here. Let me stop sharing altogether, and let me redo it. So I'm sorry about this. Let me just give me 1 second. Okay, we're back. Okay, so back to the classroom. Again, there are 3 major things for you to do this week. There is the Excel for Accountants LinkedIn Learning Certificate under the Engage and Explore folder. Open it up. Make sure to watch all of the videos in sequence. When it's verified that you've watched it, a green check mark will appear next to it. Make sure that you've enabled your pop-ups, clear your cache, and then at the very end, it should open up with your certificate. You're going to download the PDF and then upload it to the classroom, just like the other ones that you've done. Okay. So that's major item number 1. I recommend you do that as soon as possible. Really, like even tonight, tomorrow, do it quick. Yeah, because you also have the Chapter 8 quiz from our discussion we just had, and the midterm exam. So you have to submit the midterm exam on time. I cannot complete that. You cannot complete that late. Cannot. The midterm exam must be completed on time. You cannot submit that late. I cannot be more clear on this, okay? So please, 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 if you're late with anything at this point in time, you need to get that caught up and in, all right? Promise you, you're in trouble already if you're missing items. So let's get it in, okay? Whatever you got to do, just get it in. Ashley, please.
I don't see where do we upload our certificates?
It's right here. So just below the where you open up the LinkedIn Learning under Engage and Explore, the file's going to be right here. So if you open that up, you should be able to upload your PDF.
Okay, so it's more than one because I did that one, but
Yeah, I think
it's all in the same place.
Yeah.
Okay, I
It's all the
see.
same place. Yeah. If you're missing anything, just let me know. I don't think you are though. I think you did yours already, from what I can remember. Good question. Yeah, and then of course the chapter 8 quiz, and then the midterm exam. Now remember, I put this video here to help you. You open up this recording,
Right, as promised.
and there's me talking about the midterm exam. And I walk you through it, okay? I even walk you through the questions. I mean, not all. We don't answer the questions, but we go through them. I tell you exactly where to find them. All right. So I promise you, if you watch that video, you'll do very well in the midterm. Very well in the midterm. All right. So please watch it. Please watch it before you take it. And then remember, you can open it as much as you want. It's not timed. Once you click submit, though, it submits it. So just click save and close. Answer a couple questions, save and close. Go to the next chapter. Answer those 5 questions, save and close. Go to the next chapter. Answer the 5 questions, save and close. It covers chapters 1 through 8. Okay. Any questions, comments, concerns? You're all okay. You get it, right? You know what to do. You sure? All right. Well, as always, thank you all so much for your time today. I sincerely appreciate all of you being here and trying your absolute hardest in this course. It means a lot to me. Hopefully it means a lot to you. If you need anything at all, any help, even if it's something about the LinkedIn Learning Certificate, please tell me you need help. Otherwise, I don't know, right? So send me an email, say, hey, Dr. B, I need help. What do I need to do? Or whatever the case is, right? We'll get you through it. You just need to tell me you need help. All right. But other than that, you can email me, call me, set up office hours. I'm here for you. Okay. Thank you all so much for your time today. Appreciate all of you. Have a wonderful rest of your night. Thank you so much.
You too, Dr. B, and thank you.
Thanks, Ty. Appreciate you.
And I am I'm on the makeup bus now on the way home to DC, but I'm gonna do all my makeup work when I get home.
Okay, that sounds good.
Have a good
Okay,
one.
thank you.
Yeah, my pleasure. Thank you.